Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas. Today on the show, we have Damion Lupo. Damion has over 43 businesses, has 4 black belts, including a 5th degree, and is the best-selling author of 9 books with another coming out in November. He is the expert in checkbook control of your retirement money via the QRP. Damion, welcome to the show.
Hey, Juan, it's good to be here, man. I'm ready to disrupt some people's belief systems here and give them some new ideas.
Definitely. It really has triggered, something in me to learn more about this. And I think that my audience can really benefit from this. So guys, hang tight with us, here for another 30, 40 minutes, and you're going to learn a ton. So Damion, let's kind of get into this first. First of all, tell us where you're calling us from. And then tell us a little bit more about your background.
I'm calling you. I'm here in Phoenix. It sort of feels like Alaska, where I grew up. We had some major storms, and it was sort of funny. We went from 105 down to, in the 60s and 70s all of a sudden. So it was sort of this weird Arctic blast. But my background, kind of like a lot of people, just sort of grew up middle class. And although I did start those 43 businesses, the first one was when I was 11, and it was just wanting to make some money so I could basically play Nintendo games. So I bought and sold Nintendo games, and then that led into other things because once you get the itch, you just got to go do it. And so ultimately I got thrown out of college because I started a bookstore in college, and I put the other bookstore out of business. So they didn't really like that very much. And I left, and I said, okay, you know what? I'm not meant to be here, and this is not my thing. It was somebody else's dream to go through that educational thing. And so I ended up doing a little insurance selling and learned that business. And then I found real estate, and that's where I went pretty much loco bananas, and went to a seminar with a guy named Robert Kiyosaki was speaking. You guys know about Robert. And I flew out to Orlando to see him, bought everybody's tapes, and these were literally tapes.
Yes, back in the day, yeah.
Yeah, back in the day. I was like, give me your tapes. And so I had all this stuff, and I burned them out. I broke some of these things. That's how much I listened to them. And I applied what they did. And so that turned it over 5 years. I bought 150 houses. And the thing that is important about that story is that if I could do that without a college education and basically no money, like I used my Visa card to buy my first rental house, $6,000 cash advance, took over a mortgage. And so, you can really, if you're committed to it, you can do damn near anything in real estate. And so those 5 years, it was pretty amazing. I bought my Ferrari in 2005, and I looked like the world's biggest success until my ego took over and said, you are the smartest, bulletproof guy in the world. And then I lost a $20 million portfolio in 2008. So I got humbled and brought to my knees. And that was kind of the cycle of what happened for those almost 10 years.
Wow. Yeah. That's a big high and then a big low, right after that. And so that will definitely humble you really, really quickly. Yes, Damion, I appreciate you being here. And so, I think what we want to talk about here today is the QRP, and let's get into that. What the heck is a QRP? What is that?
So the QRP is a retirement account. Most people have heard, and you and I were talking offline a little bit about self-directed IRAs, and most people hear about these things, but the problem is those are a nuclear disaster waiting to happen in your portfolio. And I'll tell you why, because when you're doing real estate, one of the coolest things about real estate is the debt. And when you take out debt, you get cheap money. If you use your retirement accounts and you use an IRA, you get hit with this thing called UBIT. And if you don't know what UBIT is, it's Unrelated Business Income Tax. Here's what happens. You go buy a property or you invest in a multifamily, and there's 70% debt on that thing, and you use your IRA. Well, when you have profits, at the end of the day, when this thing sells off, you make your money, 70% of your profits, you're going to lose about 35% of those profits. So, and this is because of this UBIT thing that hits. And so most people don't know about this. I'm seeing a lot of people come to me and say, I didn't know this was coming. Nobody told me about this when I set up my IRA. And I said, why would they tell you? It'd make you hesitate. They're just going to sell you the IRA. And custodians love these things because they charge you fees, thousands a year, whether you realize it or not. And so it's a good model. They want to keep selling these things. I just have a different way of looking at it. I don't think that fees should be charged because you exist. That's kind of Wall Street's model. So the QRP is the Qualified Retirement Plan. It's basically an IRA on steroids, and it's part of the ERISA code that set up the 401ks out there. And basically what this does is it gives you real control. There's no custodian. You're in charge, and you're exempt from UBIT. So you can go invest in real estate, and when you have debt, you get to keep all the profits. The IRS doesn't get anything. That is about as good as it gets.
Yeah, definitely. So you mentioned the UBIT. I mean, or otherwise, I guess, is UDFI. Is that another term of saying it?
Yeah, so UDFI is the unrelated debt financed income. That's the income that you're basically, so
That's
like
the
if you
income.
buy a property and you have 70% debt, what the IRS says is 70% of the income of that property is because of the debt. So debt
Hmm.
financed income. And so they say if you have UDFI, which you would in these leveraged real estate deals,
Uh-huh.
then that's going to trigger the UBIT. The UBIT is the
Mhm.
actual tax. The
There you go.
UDFI is the income, the way that they describe it. So to avoid UBIT for these leveraged deals, you simply roll your IRA over to the QRP. And it's really cool because not only can you move cash over from an IRA into the QRP, you can actually move assets. You don't have to sell your interest. You can move them. It's called an in-kind rollover. So you got an investment already, you just roll the asset over and boom, no longer subject to UBIT. I mean, holy crap. That's kind of
It's
like
as simple as
a
that.
Christmas present. Yeah, that's it. I mean, okay, let me be clear. The custodians aren't going to like it because they lose all their fees.
Yeah,
And
yeah.
what we find is that custodians consistently drag their feet. They try to scare you. They say, "Oh, this is a bad idea. You shouldn't be in control because you're too stupid." And that's the model. It's the custodian model is very similar to the Wall Street model. And I don't pull punches on this. I just call it like it is. Custodians make money by keeping your money trapped. And even if you're doing real estate, they get fees because of your account balances. Their idea is we want $1 billion under management or 10 billion, including your money. With the
Right.
QRP, you are managing your own money, like it's in your hands. So you have $1 million or 10 million in your account. You don't have a percentage of that going away every year. That's a huge difference.
Yeah, it is. Yeah, it is. So, what's the main reason why you can avoid the UBIT tax on a QRP? And why can't you avoid that like on an IRA or whatever? Why is that?
So one of my mentors, Jim Rohn, that I listened to, one of the guys that I burned out all his tapes in the early 2000s, would say that's a question that is left to remain as one of the great mysteries of the universe. And I say that because I have no idea. It's just the
It's
IRS.
just the way it is.
Yeah, if you look at the IRS code, it just says it. This triggers UBIT if it's an IRA, and if it's a qualified plan, it doesn't trigger UBIT with debt. So gosh, I don't know. I mean, it's just one of those things where we say it is what it is, and let's not try to figure out what the IRS is thinking because that'll
Got
make
it.
you
Got it.
crazy.
All you can do at that moment is just to take advantage of the benefit, right?
Yeah, yeah. I mean, here's another thing too. It's like saying, well, why does there's a famous debate with Hillary Clinton and Donald Trump where Hillary said Donald doesn't pay any taxes, and Donald said that's smart. Well, all he's doing is using the tax code, so
Yeah,
you can
to
argue
his
the merits
advantage.
of it, but
Yeah.
we all have the tax code. Well, it's just what it is. So either use it or try to yell about it. But I think it's better just to use what is there and play within the rules. And that's what the rules say. Use this, don't pay tax. Use an IRA, get hammered.
There you go. There you go. I like that. I like that. So, let's kind of get into the contributions. I guess kind of do a side by side comparison, versus an IRA, or a 401k IRA, and then the QRP. What can you, how much can you invest, annually on each one of those plans?
So with an IRA, you're limited to $5,500, and so we'll just talk about somebody that's 45 years old. It's
Okay.
$5,500. It's a little bit more if you're over 50, but it's $1,000 more. It's insignificant. But so basically, you can contribute $5,500. If you make too much money, which is like 120 grand, you can't do a Roth, and you have to start playing with backdoor stuff. So basically, you're stuck. Maximum $5,500. It's really limited. And with the QRP, it's 55,000 per year that you can put in, and you can do Roth at any limit. I'm sorry, any income level. So it doesn't make any difference if you make $200,000 or $300,000. You're fine. You can contribute this 55,000. It can be Roth if you want. So you've got all these options for contributions. That's, by the way, that's 10 times. That's a 10. It's literally exactly 10x. That's
That
a
is.
day. And so it's the difference between those. They're different parts of the tax code. The IRAs were set up differently. They're newer. The 401k code with ERISA was back in the early 70s. So this has been around a long time. It's just it's a better strategy for you to control your stuff. I mean, it's also interesting. We were talking about the Roth offline, and I don't know if you knew this, but Mitt Romney has the estimate is between 40 and $100 million in his Roth account.
Yeah, that's
And
insane.
and so this is what the rich are doing. So if you want to understand that, they're doing Roth QRPs. That is exactly what they're doing.
Yeah. Yeah. And, they're going to do whatever is best, obviously, because, a lot of these guys, they know things that the average person does not know. Like Donald Trump, you mentioned him, you think he's doing, what the average person does. No, he's doing things that, most people don't know about. And, maybe the QRP is something that you don't know about right now, but, that's why we're talking about this, on this podcast. So like that you can, know more about it and see if that's something that might be of interest to you and of benefit to you as well. So, that's some good stuff. So what kind of investments can we do, or what kind of things can we purchase with the QRP?
It's another really strange thing about the IRS code. The IRS says here are the 12 things that you can't do, and then that's it. Basically, it means everything else you can do. So things that people do common, they invest in syndications, multifamily, land, single-family houses. They invest in physical gold. So another big difference, if you like gold and silver, physical gold and silver, you can actually buy it with your retirement money and take possession, like with deferred money. And what that means is that you're getting like a 30% discount, because normally you would buy your metals with after-tax dollars. Well, here you can buy it, hold it. With an IRA, you can't take possession. It is literally against the code. And if you look at the code, by the way, some of you are listening and you have gold, and maybe you bought it with your self-directed IRA, you can't. And if you look at the code, it says you can't. But a lot of custodians try to play games and say, oh yeah, it's fine. It's not. It's literally a black and white thing. So with a QRP, you can buy the gold, international investments, land, private placement. You've got a business that has shares and it's an early startup type of business. You can invest in those. Tax liens. The list is kind of endless, whatever you sort of can come up with. They say you can't invest in things like wine or collectible cars or rugs. It's basically because they don't want you to use this stuff before retirement. So if you went and bought a rug or a bottle of wine, you probably consume it or tear it up. So it's basically a limit on those specific things that you can't do. And then there's some specific people that you can't invest with, like your kids or your parents. Most other people you can invest with and do deals with. So it's pretty wide open. I mean, it is really meant to be it's set up for somebody that's very self-responsible, that believes that they are going to care about their money more than somebody else, and is willing to invest the time and energy. This is not for somebody that typically hands their stuff over to somebody and says, just take care of it. This is not for them. Like literally don't even ask for my book if that's you, because but I'm down, people that are doing syndications, generally, if that's of interest, you're self-responsible. People don't do syndications because they're checking out and they're handing their money over to Wall Street. That's not the person, that's not you listening right now.
Yeah. Overall, you have to be responsible. I mean, it's just like anything else. You got to be responsible, and don't use it for anything stupid, really. Frankly, I mean, that's just the name of it, right? So, let's say somebody has an IRA. How easy is it for them to roll over into a QRP, and what is the process like?
So it's easy. Like we make every part of what we do for people when we set up your QRP. We make it very simple for you. We deliver things. It takes us 3 days to give you everything you need. And then the fun begins. It's called getting the custodian to release your stuff. Like their fangs are so deep into your money, into your wallet. It's hard to imagine. And I like to be really open and candid with people. Candor is one of my 6 key values. Candidly, most custodians want to keep your money as long as possible. I've seen the California pension system take 4 months. That was the worst case. That was crazy. But it's also because that system is bankrupt. The guy named Jolo, the $1 Billion Whale, if you want a really crazy book, the $1 Billion Whale, was part of the investing in that fund, and that fund invested in him, and he sucked $1 billion out and stole it. So the reality is these custodians don't want to let go, and it'll take them 7 days to 14 days usually, and they like to send paper checks. I don't know who uses paper checks other than custodians now, but they use paper checks typically. So the whole process is usually a couple of weeks, and then you've got checkbook control of your money.
Oh, so I mean, it's pretty quickly. I mean, as long as you have your ducks in a row, then a couple of weeks, it should be you should be good to go. So we mentioned earlier that there's a lot of different plans that you can roll over into a QRP, and I think we discussed this a little bit offline. Which of these which plan can you not roll over into directly into a QRP?
The one thing that the IRS doesn't allow you to do is roll a Roth IRA over into it. So what happens is a lot of times people either set up a Roth IRA or they move an old 401k into an IRA and then they convert it and then you're stuck. So if you've got old 401k money and you want to roll it, or even if you've rolled it into an IRA, you can roll it into a QRP, or you can roll it directly from your old 401ks into a QRP. So it's basically, once it's a Roth IRA, unfortunately you're stuck. And so just check this out before you start rolling things around. If you've got old retirement money from a previous job, that money can be rolled over, and that's prime. That's a beautiful situation. It's just when we do what we thought was best, like I did this years ago. I set up a Roth IRA. I can't move that money into my QRP. I'd like to have it as a Roth QRP, but the IRS, in their wisdom, decided that they weren't going to let anybody do that. So don't let anybody tell you that you can, because it's not true. And you can there's a rollover guide that is really clear that you can't do that.
Okay. So what if you wanted to go backwards? And this is a little bit off subject, but what if you wanted to go backwards and say, okay, you're in a Roth IRA right now. You're using it for whatever reason, right? But you wanted to go to a traditional IRA and then maybe roll it into a QRP. Can you do that?
There's a strange rule, and in fact, by the time you're listening to this, it's probably going to be gone, because it's after October 15th is basically when you have the extension for your taxes. And there's this basically undoing of a conversion that happened for 2017. So it's probably not relevant when you're listening to this that you could do it. Basically, the only way to get money out of a Roth IRA before you're 59 and a half is to pull the basis out. So basically anything that you contributed, you can always pull that out at any age, tax-free, penalty-free, because you've already paid taxes on it. So you can always pull that out and then recontribute it into an IRA or a QRP. And then at that point, it's easy to put in the QRP if it's not there already. So that's how you get money out. Or you just say, hey, I'm taking the penalty and I'm taking the taxes. That is something you want to have a conversation with your CPA about, because there are consequences. You're going to lose half your money probably with taxes and fees and everything and penalties. So I would just be really careful about that. I certainly wouldn't say go do that without having a professional, an advisor, get in the middle of that conversation and tell you what the consequences are, because they can be pretty stiff.
Got it. So we've heard the term, QRP, but we also have another term, EQRP. So, tell us what that is. If it's the same thing, give us an overview of what that is.
So we created the EQRP. This is what we do. It's different in the market. It's the Enhanced Qualified Retirement Plan, and it's unique to what we do. It provides liability protection that you normally wouldn't have with an individual type of 401k. And so that's very, very different. The last thing that you want to do is build up a retirement account and then you get sued and a judge says, hey, we're going to take your assets. You don't need this much money. You're too rich. And unfortunately, there's a lot of activist judges out there that will decide you have too much money, and somebody that you harmed, I say harmed with air quotes, that somebody tripped over your tire on your car or something, and they sue you. That's a big problem. And that's, the industry really isn't telling people that until you've been in a lawsuit. And if you're in real estate long enough, lawsuits happen. It's just part of the deal. And if you're in America long enough, you probably get sued just because you're here. So my suggestion is make sure that you have your liability protection covered. You've got the right insurance and you've got the right plan. The EQRP is the strongest, most protected plan with the most control in the country. There is no close second.
Wow. Okay. Well, then tell us, are there any downsides in having an EQRP? I mean, anything negative that you see?
Yeah, I mean, if you're reckless or you're not paying attention, you don't balance your checkbook. Like a lot of people, when people are telling me about their story, they tell me what is going on in their life. I say, let me see your bank statement. Let me just show me your credit cards. And people go, because well, one, they don't know what's really going on. They're not paying attention. And it's that type of person that's where this is dangerous, because there's nobody looking out for you in terms of balancing your accounts or keeping your records. You need to keep your records. So a lot of times people are moving so fast, they're so busy, they just don't do that stuff. And if you don't have somebody doing that, helping you, or you're not doing it, you're going to get yourself in trouble, because you're going to violate something, you're going to end up getting audited, and you're not going to have your stuff straight. So that is the downside with the custodian. If you don't do any of that stuff, the custodian's going to have records. They're going to keep all of your records. They're going to check with you on valuations. So that may be a better option for you. And it's really dependent on whether you're going to stay engaged and whether you're going to be responsible. It comes down to that one thing. Are you responsible? And if you are, this is a great thing to look at. If you're not, do not come near this thing.
Got it. Yeah. I mean, again, like we touched on earlier, I mean, it's about responsibility, and it's about knowing what you're doing basically. And so yeah, be responsible. I want to go back to the EQRP. How is it held? Do you have like a custodian? How is it normally held? Because I know in a IRA is normally like that, right? So how is it held in a QRP or EQ?
So in the qualified plans, you are the trustee. So the trustee and the custodian are really kind of the same thing, where they're the party responsible for the oversight, the fiduciary responsibility for the assets. And so a custodian is looking at the assets, and that's why they create a lot of delays and friction, and you have to get approval to do a lot of things because they're responsible. So you are the trustee in the qualified plan. You can actually have somebody else do it, but it's rare because if you're gonna take control of it, generally you want to have control and have speed and not have somebody that's going to get in the way of your investing. So that's you. I mean, there is nobody else. If you want to be all the different hats, it's black and white in the tax code. It's up to you to choose who that's going to be.
That's why you were talking about earlier that, this is not for everybody. If you're reckless, then it's not for you, so you pretty much are the person is going to be, directly with you. Is there any kind of protection that you have using a QRP? I mean, any way that you can protect yourself or your assets any other way?
Yeah, with the EQRP, you have protections from litigation and liability where people really can't get through, and that's the way that we've built it. It's on purpose to protect those things. The courts have the ability to penetrate IRAs and individual 401ks because, like with individuals, the ERISA code, which is set up in the 70s, which built the 401k system, that doesn't cover an individual 401k. So that's a big problem. A lot of people don't realize that. They go, oh, I can find a cheap solo K or something. The problem is those don't have the liability protection that they think that they do. So if you look at the code, it's very clear. It says ERISA does not cover you with an individual plan the way that a group plan. If you're at a big company and there's lots of employees, you are very protected. And unfortunately, with an individual plan, an IRA or a solo 401k, that they don't have those protections. So it's up to a judge. That is a major problem. I would say the first time you get sued, you'll learn this, and you don't want to have to learn by losing all your money. Learn by just understanding the code and saying, okay, how am I going to protect myself from this?
Yeah, that makes total sense. Also want to ask you, what type of fees do we have? Are there any annual monthly fees that you have to deal with?
No, it's flat. We set up a number of different types of things, and they have a setup fee which varies, and they have an annual fee. And the annual fees are less than $1,000, regardless of the size of the assets. It's not based on an assets under management. Custodians, Wall Street, it's all AUM. That's how they make their money, charging you a percentage of your stuff and then feeing you to death for everything. So ours is a different thing. It's flat, it's transparent, it's unlimited, whatever you need from us, and setting everything up from A to Z. It's all included. So and one of the things that is really unique too, people that have an individual plan sometimes hire employees. You do well, you hire an employee. Well, your plan needs to change, and people that set up individual plans typically say, oh, yeah, we can't, it doesn't work anymore. Well, they're right, it doesn't, and they generally can't fix it. So we have the ability to work with people, whether you have 0 employees or you have 5 or 50, it doesn't make any difference. That's a game changer for people because you don't want to be stuck in something when you want to hire an employee. That's like, you get bigger and more successful, you want to hire some help and leverage up. So we can solve all those things, and people that are just doing like the solos or the custodians really are kind of stuck in most cases because they can't accommodate you if you have employees of any sort.
Yeah. So going back to the taxes a little bit, when reporting to the IRS, what kind, this is more of a, CPA related question, I guess, that will help you out really. But is there any specific form that we have to, fill out to send directly to the IRS for this?
Yeah, well, let me just say, any form you send to the IRS, you should not be sending it. Your CPA should. Just a side note for sure. Yeah, side note to everybody out there that thinks you're a CPA. I remember 15. I remember looking at things going, do I really need a lawyer? When you're 20 years old, you think, oh, I can just do these things on LegalZoom or something, and that's a mistake. And same thing with accountants. So now accountants and attorneys do legal. They do all the forms. They build everything. They file everything. And so your CPA is going to file a form 5500 if you have over $250,000 in assets in your plan or you have employees. And that's the annual form. And it's basically just saying, here's what's in the plan. Because typically with the qualified plans, you're going to have real estate and other assets that are not part of a brokerage. And so you've got to have a valuation done on those and then let the IRS know, here's what's in the thing. And that's what you do on an annual basis. It's filed with your taxes. It's a non-event. It's really, really straightforward, and CPAs can do it all day long. And it might cost you a few $100 a year, maybe 500. If it's just you could do it yourself. There's not a lot to it.
Okay, so I mean, you pretty much have already gone through a lot of the overview, the big overview. But is there anything else that we're missing that we haven't necessarily discussed?
Well, I mean, so there's two ways that you can really put money in this thing and get money into it and then grow it. I mentioned before that you can have this being deferred money or Roth. When we build it, it comes with both of those components. And so you can either roll money over from previous employment or IRAs, all that stuff other than a Roth IRA. And you can also do the contribution. So you can put up to $55,000 a year. And if let's say you're married, you've got a spouse, and you have a small business, and you're an investor or whatever. The two of you, that's $110,000 a year that you could potentially put into your plan, and it's based on a formula around your income. So it's effectively a percentage of your income that you can contribute, and so there's some nuances that we get into when we look at your situation. The reality is it's not overly difficult to be qualified for this. If it fits you and it makes sense, it's really pretty straightforward to do. I know some people out there, I've had some custodians, I've been at live events, and these custodians shake their head, that's not true, you can't everybody can't be qualified. And I go, look, man, if you have a lemonade stand in your front yard and you're doing business, you are qualified. It's called business activity. That's what's required. It doesn't awesome. Take that much. So you know what, go get a freaking stand, put a lemonade out there and say 25 cents, get a quarter, you've got business activity. And so it's not overly complicated. I think a lot of custodians try to protect their ground, and they're trying to keep people stuck. I just don't like people being stuck. It's a philosophical difference. I like to break the shackles.
Yeah, definitely. One thing that I did want to ask is what happens to your funds if, let's say that, you get really old and you die, or just die suddenly, whatever. So what happens to your funds, and how is it easily, transferred over? Or let's say, you had a fund, together with your, significant other, maybe your spouse, your wife, or whatever. So, God forbid, something happens, you're both gone, then how is it easily transferred or not?
So I went through this with my dad's accounts when he died a few years ago, and processing all that stuff. And every account, whether it's a bank account or it's a retirement account, has a beneficiary attached to it. If you don't have a beneficiary, you're just setting yourself up to be in a big probate event. So when you set up an account, if you have an IRA or a 401k right now, make sure you have a beneficiary form filled out, and whoever is your executor of your estate has that form. And that's all it is. It just goes directly to that person. And typically that money is outside of probate. It's outside of the estate. So like when my dad died, he had accounts and I was the executor, and I couldn't even get information about them because the money went directly to the beneficiary. So that's an interesting thing. It keeps it kind of quiet. It's not public. It's private, and it's fast. I mean, it's literally, hey, here's the death certificate, here's the beneficiary form, and the bank or institution just says, okay, and they write you a check, or they say, we'll transfer the account over to you. And then here's a cool thing. If you inherit a Roth account that somebody has set up, you get to use that money the rest of your life, grow it, spend it, whatever you want at any age, tax-free. So just think about that. You're 30 years old and you inherit a Roth account, and you go, okay, there's $100,000 in here. I can build this up to $1 million. I can spend it all right now. No taxes, zero, zilcho. I mean, that is a game changer for people thinking about legacy income wealth for their families. You can take yourself out of the tax system. I mean, that is a major difference versus giving away 70% of your income to the IRS.
Yeah, definitely. That's powerful. So, that was another question that I wanted to ask you is, what happens, once they do, it does get transferred over, to the beneficiary, what happens as far as taxes is concerned? You pretty
if
much,
it's Roth, it's none. There's a RMD, which is a required minimum distribution. And basically that, like I have one of those and it's like based on your age, there's a percentage that you've got to take and distribute. It's like, 2, 3, 4% a year based on how long the IRS says you're going to live. So that's really what we're talking about. And then the rest of it, you get to keep growing.
Okay. Awesome. Awesome. So yeah, we're going to wrap this thing up. But before we do, I want to mention to you guys out there that there's this book here that's very powerful. It's called the QRP book. So this is, a book that is actually written by Damian himself. And so, I want you guys to check it out. It's got a ton of powerful information in it, regarding the QRP. So it's just another way that you guys can, transform your mind and, know that there's other things out there besides the traditional 401k, IRA, whatever. There's another avenue here, and it's even more powerful than those. Yeah, and I think you mentioned that you have another book coming out. So when is that book coming out?
I do. At the end of November, my next book's called Unicornomics, and it's about building $1 billion company and behind the scenes, what it looks like, the mistakes, and really what you need in place if you're going to have a fighting chance at creating $1 billion company. And the reason that's valuable, I think a lot of people go, I don't care about $1 billion company, but most of the same things need to be in place for a $10 million company. And let's be honest, $1 million is middle class. I mean, you're not going to be rich with $1 million. It's 10 million. That's really what, if you want freedom, you've got to build yourself up to that level. And so Unicornomics was my experience of being behind startups and building over 40 businesses, and what it takes, the teams you need, the culture that you need. And it's a mini book. So it's very, very easy to read. There's stories of the actual experiences and then an action plan, and you'll have a blueprint and a dashboard on how to build and then operate your unicorn. So in terms of the QRP book, Juan, if people that are listening, if you grab your phone, you're probably on your phone right now, text the word QRP, all caps, to 72,000. And you'll get a report that's basically summing up the book. And then if you want the book, you can get a copy of the book too. But if you just send the word QRP, all caps, to 72,000, it'll immediately give you the report. It's like a 14-page cliff note. So you can zip through this thing and go, oh, wow, this is some cool information. So if you want that, it's theirs. Just send that quick text and it'll be sent right over to you. Nice.
So go ahead and guys, make sure you do that. And yeah, Damian, it's been a pleasure. I appreciate you sharing, another avenue here for those of us that wanted to, look into, saving or actually, deferring those taxes, is really what it's about. And so thanks a lot for sharing the information, and I wish you continued success.
Thanks, Juan. I appreciate it. Everybody listening, thanks for listening, and thanks for learning with us. So thanks a lot for the time.
There you go. Thank you so much.